Hello, everyone, and welcome back to the Property Hustler Show. My name is Andrew, and today Ping and I are going to be discussing Cleveland, Ohio, why Canadians are looking to alternative real estate markets to do their investing, and what is the benefit of investing in Ohio. So, Ping, let's get it started.
Let's go.
Okay, so we've been looking at Cleveland and dabbling in the real estate market over there for about a year now, right? And what are some of your initial thoughts?
My initial thought is how come we didn't get in earlier?
One of the most attractive things I feel that people are not even completely aware of is exactly how much more affordable properties are down south.
Yeah, I remember the first time that we looked into the market, and then when I was showing to you, and there was one property, it was under 100K, like 80K, right in front of the water as well.
Yeah, you can't even buy land here at those prices, right?
And this is one thing that I noticed about a lot of Canadian investors. So they had the exact same mindset as we did back then. We're simply just not aware of that the market over there is so affordable.
Yeah.
It's not that far away either.
People literally view it like international investing. Some of the qualms I had about going down there was, first of all, as a Canadian, am I even allowed to own property over there? I know people did it, but I wasn't sure exactly how. Like, did they have a spouse? Did they have a friend? Did they open a corporation? Did they get a visa? Like, all these questions that people have, and they just say, oh, it's probably not that simple or straightforward. So they don't even look into it.
Exactly. That's the problem, right? It's the inconvenience of having to dig through all the information, right? Try to understand a new market. But here's the thing. How many people own a property in Florida?
Yeah.
So many people, right? Like I know a few people, right? And it's not like I was born and raised in Canada. I still know a few people. So I'm pretty sure everybody can name a few people in their own circle, that has some properties in Florida. So this is not a new concept, is what I'm trying to say.
Yeah. And it really starts to become a little bit more appealing when it becomes feasible for even people who don't want to be investing in real estate too far away, because that's a big hurdle for a lot of people. People want to be able to buy real estate that they can drive to if push comes to shove, right? If something goes wrong and I'm a handy person, let's say, and I want to be able to visit my property because people get into real estate because it's a tangible product. I want to go there and touch the house.
Exactly.
Some people want that. But now people are looking at places like Sault Ste. Marie, Timmins, Sudbury, all these places, and they're pretty far too.
Oh, they're very far.
Yeah.
They're very far, yeah.
I remember last year at this time, I remember looking at Sault Ste. Marie with Skylar, and I was asking him about the industry over there. And I remember it's because we found this one 16-unit building for like $900 and something thousand. You remember that?
Yeah.
Yeah. And that I was like, okay, that's crazy, right? But it's like over 8 hours away.
Exactly. And I didn't think it was a good idea. I still don't think it's a good idea.
Yeah, well, that's the thing that you mentioned to me, actually. So I remember you were talking to some relatives, I think, and some other investors, right? And, the age that your father is at, the majority of Canadian wealth is held in the boomer population, the older people, right? That's where the majority of wealth is. And where do they want to go in terms of just where do they want to live? Where do they want to move to? It's definitely not north.
Mm-hmm. It's usually south.
It's usually south.
Yeah.
Right? So if you're going to ever consider following the money, you kind of got to follow where some of these people are going, because they're going to be taking their money and going elsewhere.
100%.
So north might not be the best option, but south starts to look a little more promising.
100%. People only go to north because it's a little bit more affordable.
Exactly. Right. And sometimes these places really get bolstered because of the incentives, for example, like even work incentives. Before we start talking about like Ohio, even like when you start looking north, the further north you go, the cheaper things do become. But then also people who go there, especially from the south, they're usually there because of some incentive. Nurses go up north to do remote nursing or all kinds of other things. Thunder Bay has programs close to the Hudson Bay.
Hudson Bay, oh, okay.
So the minute you start, even like Northern Ontario, the minute you start going up there, there's not a lot of people up there relative to further south. Actually, that's the thing. Majority of the Canadian population lives all close to the border.
Interesting.
Right? Majority of the Canadian population.
Yeah, you're right.
It's all right there. So if you think about it, driving to certain American cities to do real estate is closer and easier to get to than going north.
Yeah, totally makes sense. Yeah. I think a lot of people are just having that kind of mental barrier because that's what we had too. It was a lender qualification, also double taxation. Well, some people are not even aware that there might be a double taxation, but it's just you now need to kind of follow different rule, different regulation, right? With the lenders, with how the tax works and all that stuff, right? And considering that you still have to cross the border to visit your property, it just seems like a lot of trouble.
Yeah.
But the question here is that what happens if the price point is only 1/3 or 1/4 or even in some cases like 1/10, right, of the market? Then all of a sudden that effort becomes like a lot more rewarding.
Yeah. And just for context for the listeners, I feel like it's important to mention if you're, let's say, somebody in Toronto and you're considering investing in property in, let's say, Hamilton, Oshawa, St. Catharines, even Windsor, right, where you can find properties in the $500,000 to $700,000 price point. You can find some that are sub 5, but these are like, they need a little bit of work. They're definitely not turnkey cash flow properties.
No.
Yeah. Those price points start to touch the higher echelon of properties in Cleveland. Like you're now getting some like monstrous houses. You're getting like not, I want to say mansions, but definitely big houses.
Much bigger one, yeah.
Exactly. But those properties are actually more comparable to, let's say, $160,000 to $200,000 properties in the US
Right.
that do cash flow.
100%. And it's from day one too, right? As soon as you acquire it, even with tenants in there, you're gonna see some cash flow. It's just not optimized yet.
Exactly.
It's kind of like what we bought in Hamilton 10 years ago.
Yeah. The 10-year ago thing is a very interesting way to look at it because it does reflect on a time.
Yeah. My first rental property, a student rental, like the cash flow is like $400 from day one, right? Without doing a lot of work. So yeah, that, and I do believe that that's how a real estate market is supposed to be, right? Like if you find a good property, like a good area where, there's a decent enough of a population, migration coming in, there's a job opportunities, right? And it's balanced between supply and demand. Usually you're going to be looking at around like 200, 300, 400K, right? Around that range. Even if you look at the major cities in the States, right? Texas, some areas in Texas, right? Some areas in Arizona, right? I'm not talking about the place that has been like really inflated. I'm talking about just like surrounding area, 45 minutes away from downtown. You're going to see properties going around like 200 to 400K. That's what's supposed to be normal.
Yeah.
Right. So a lot of people, I think the biggest reason why people stop or not even bother to consider the US market is because we've been pretty spoiled. Right. We've been very spoiled with all the inflation, appreciation in Ontario market. And that was also the reason why we knew that this is a smart move. This is a right move for the business development side. But not until 2022, right, where things really went to different, the market went into different direction. Prior to that, we were just so busy, like dealing with the business here. We didn't have time to look elsewhere.
Yeah, that's unfortunately a time where we were so busy, where we had still some things that are, where some parts of our work was still tied in the business rather than, taking a step back and looking on the business.
Exactly. Also because of the appreciation, right?
Yeah. Things were good. When the going is good, it's hard to look somewhere else and say, oh, yeah, let's look at opportunity elsewhere when there's opportunity right in front of you. And the thing is that people have different investment philosophies, right? There's the philosophy of like, okay, you're getting distracted by something shiny. And if you just look in front of you, can't you make money with that which is already here?
Yeah.
The answer is yes. You can definitely make money with that which is here. But the question now is, do you really want to have to try that hard to make money?
Exactly. Yeah.
Right. It doesn't have to be that way. And I think this is why it seems like across the board, a popular Canadian real estate investing strategy is let's invest in the US.
Yeah. And also like multifamily. So many people, so many workshops are promoting multifamily, right? Which I get. But for anybody who just starting out in real estate journey, the it's very capital intensive, right? And the only way that you can fully, leverage the CMHC MLI Select, the only way that you can do that is to have pretty big reserve, get a tenancy turnover, right? Renovate the units to a certain standard. Then you can qualify for it. But even that, you have to wait for several months right now.
Yeah.
Right. So I don't know. I find that the approach is only suitable for people who already own a few properties or maybe already own a building, right?
Exactly.
If you're starting out, honestly, I'll look for something easier, right? A little bit farther, that's okay. Because you know what? If you look for a landlord-friendly state, hiring a property manager becomes very easy too.
Exactly. If we're not going to consider too much the people who are sitting on, let's just say $700,000-$800,000 in order to buy a property, improve it, deal with tenants if you're buying multiplex in Ontario or in Canada, really. If we're not talking about those people who are considering those options, let's talk about the product that people who are getting into real estate or small to mid-sized landlords can look at in Cleveland. So let's talk about price points.
Sure.
Okay. Single family to duplexes. Okay. In Cleveland, the important thing to understand is that between 2 to 5 units is considered multi-residential financing, where you can still get residential financing, and anything above 5 units, you're now going into more commercial mortgaging. Okay. So for properties themselves, right, that are priced single family to small multi-residential under $100,000 or in and around that price point, would you consider buying a property priced around there or not?
No.
Why not?
Okay, under 100K usually means it's in a C-class neighborhood,
Okay.
right? Which means in order for us to expect any appreciation, it's going to be very tough. Number two is when it's under 100K, the mortgage qualification becomes extremely challenging because nobody wants to go through the whole process to lend you 60 to 70K. You can get that money somewhere else, basically,
Yeah.
right? So I probably wouldn't look at anything under 120K. 130K in the US.
Okay. And over $120,000, what type of properties are you looking at? What type of neighborhood?
Then as soon as we get into more like above 120, 130, then you can get into but B minus neighborhood. You started having a bit of options. If you can push that to maybe 200K, then 100% you're in B class neighborhood.
Yeah. Just really quickly to talk about the classification of neighborhoods, right? Because in Canada, when we talk about maybe A-class neighborhoods, B-class, C-class, D-class, there isn't going to be as much disparity between neighborhoods as you would see in Cleveland. And I feel like people who are considering it as an option really need to understand this. When we're talking about C-class to B-class, there is a pretty significant difference in terms of what you can expect. Like D-class, we're not even going to talk about it, right? And you can find some D-class properties for like $50,000, $60,000, but good luck hiring a property manager to take care of it. You're going to have to hire people with with Kevlar.
Yeah, exactly.
Right? Like we drove through some of these neighborhoods and honestly, it's something else.
Yeah, it almost feels like the entire area has been abandoned by the city as well.
It's like, yeah, people don't seem to want to deal with it. And what's interesting is that the separation between D class to C class to B class is actually very thin. It's like literally one road that separates them. And exactly, right? And you have a little bit of bleed out in the areas. And this is why I know that even Roman was saying, he's like, if I'm going to buy in one of these neighborhoods, I want to be insulated by 2 other neighborhoods that are okay.
Yeah, which is a 2-minute, 3-minute drive.
Yeah, exactly, right? Like if you're looking at Europe, you want to be Germany that's in the center. You don't want to be Greece. You don't want to be freaking Spain. You want to be any of the countries on the border. Right, so that's kind of what you're doing there. But in terms of understanding the price point, let's just say we want to find a property in an area that, let's just say, a Canadian real estate investor will feel comfortable. What price point and what neighborhood, what classification of area should they be looking at?
That is an amazing question. So here's the thing: a lot of Canadian investors. Let's understand one thing. Let's define one thing. How much budget and capital can we actually work with? Let's use 50 to 100K because that's where a lot of people will start considering real estate market. Okay, if you have 10, 20K, okay, that's a different conversation because you have an income problem where those 10 to 20K might need to be put towards different type of strategy. But if we're strictly talking about, hey, I have about 50 to 100K or access to the HELOC where I want to deploy the capital, what is a good starting point and where's the sweet spot? Then I would say try to look for a property. Hopefully it's a duplex, legal duplex. It's being built in a certain way, right, to have the separate meter, separate entrance, separate, gas line and all that stuff, right? Furnace and all that stuff. If you can find something like that between 180 to 250K, I would say it's a pretty decent starting point. You can find a decent property, turnkey, maybe with a bit of a touch up, right? And then in a B-class neighborhood. Okay, so that's where I would start targeting because number one, it makes the lending, the mortgage qualification extremely easy because now the price point is a little bit higher. Lenders are usually like, okay, well, even though you're from Canada, it's foreign investor, but as long as you can show me the proof of funds, I have no problem processing through everything and then get you the funding that you need. Also, 2 units, 2 income provides a little bit more guarantee to the lender over there, right? And on top of that, this is also one thing that's really important. I know a lot of people do have access to huge amount of HELOC, right, from Canadian asset. Right, because if you purchase a home prior to 2017, 2018, the chances are your property has appreciated pretty significantly.
Yeah, what do you consider a huge HELOC, by the way, just as a number?
3 to 500K? Yeah.
Pretty easy. Actually, I shouldn't say it's easy, but a lot of people do have access to to the equity in their properties through some kind of a line of credit.
But here's the thing, though. With that kind of size of a HELOC, a lot of people are reluctant to pull everything out to buy one property, one single family or duplex here in Ontario. It won't cash flow because it becomes 100% financing. And what happens if you end up finding a tenant who's like falling behind in rent?
Yeah, and then there's a lot of fear behind it.
Whole nother conversation, like right here, right? So what I would do is I would maybe pull out 100K, allocate those funds into the Cleveland market. You don't need a high loan to value for your property, or you can do 200K, buy everything cash, right? And then select one property with two different units, create that cash flow. Another thing that a lot of people need to understand is that even though the rent payment is not as high as what we see here in Ontario or like even in BC, right? Although it's like the market has been inflated quite a bit. But over there, one unit, if you do it right in a decent neighborhood, you're still getting about 11 to 1300 per unit for 2-bedroom apartment. Times 2, we're looking at 2400 to 2600. If you're buying it at 180K to 200K for duplex conversion, sorry, not conversion, a duplex, this is a way over 1% rule, right? And if you can select the right area where there's a migration coming in the past like several years, and there's a projection for the next few years, there's a, appreciation that you can also expect.
Yeah, and I think that's one thing to clarify about the Cleveland market is that it does have pretty good future prospect in terms of appreciation and growth in both the industries that are moving into the area and also where the population is growing. Now, the only thing about it is that it's not going to be as drastic as it is in some places. Like in Columbus, for example, I know Intel went in there and they are opening up offices. You may see faster appreciation growth over there. However, the property cash flow is not going to be as significant as it would be in Cleveland. So if somebody's comparing it, you can probably look at a Toronto-Hamilton comparison back in the day to Cleveland versus Columbus.
Yeah, 100%. Yeah.
Where the growth is just different. Now, before we talk about, let's just say, operation with like landlord and tenant, because I know that the reason why people have reservations in Ontario about investing into certain multiplex, especially ones that need work, is that you can be held hostage as a landlord by your tenants if they cause you problems. You're just essentially floating major costs. What is the difference between that in Cleveland versus in Ontario?
Okay, our previous one, well, at least my previous one is 13 months, okay, in Ontario. Okay, here in Hamilton. And actually, there's another one. The most recent one is last May 1st. We had the eviction. May 15th, we had another eviction hearing for two different tenants but in the same building. Yeah. Okay, one decision got issued within 2 weeks. So that was nice. Okay, but the other person, the adjudicator, quit before issuing that decision. We had to wait until February this year.
Yeah, it's almost 2 years.
I know. Actually, more than 2 years since we started filing. Oh, okay. Yeah, more than 2 years. But here's the thing, though. February, we received the notice. Not about the decision. It's about, hey, guess what? We need to reschedule the hearing because the adjudicator left. Right, so we had to wait for another month to have that hearing. But this time, fortunately enough, that we received the decision also 2 weeks after.
Yeah, faster. I think they understood that we got the short end of the stick.
Yeah. So comparing the ridiculous case here versus the one that we just went through in the apartment buildings that we acquired last summer in Cleveland, in Bedford. That one only took us 3 weeks to get the tenants out, right? Because he knew that, hey, like he's messing around, he's not paying rent, he knows like what's about to come is the eviction, right? And there's also a security deposit that's being held by us. So reached an agreement, gave him the security deposit back, and then he moved out. We had a renovator going in there, fix up the units, right? By the end of the second month, a little over second month, actually, we got the units listed for the market again, right? So turnaround time, worst case, budget for 3 months.
Yeah, actually, the average that I know people have been saying, other real estate investors in Cleveland say, is like 2 months. They're out pretty much for sure, right? So if there's delays on anybody's part, then it could be a little bit different, but it's definitely a lot more workable, right? And there's a lot less uncertainty. Even when we're visiting properties, I remember feeling like we weren't getting as much pushback, where there's no continuation even of the lease. So the tenant population over there, they want to actually work with the landlord because they want to have the relationship where the landlord doesn't want to have to ask them to leave,
Yeah,
right? Because if the lease ends over there, you can ask the tenant to leave.
exactly.
And you can have, therefore, some rent turnover if you want, or if the rents go up, you can increase it accordingly.
100%. Yeah. So the respect over there is totally different as a landlord.
Exactly. So that's different. Now let's talk a little bit about another price point higher. Let's say somebody's sitting on a little bit more than $50,000 to $100,000 and they want to buy something a little bit more robust. Right? First of all, is investing in A-class neighborhoods worth it? Should anybody bother? Why or why not?
I still think you can consider if you're planning to allocate some funds over there for A-class neighborhood for peace of mind, right? Because the truth is, A-class neighborhood, when we went in there, feels nice.
Yeah, if it does feel nice.
Right, the coffee shop that we went in was like we could tell that the people over there was just like it's the people that we see here basically, right? And you can tell that people who are like even the cars that they're driving is a lot better. People who are walking on the street feel safe. The store is very a lot of stores that we went in is pretty organized and cozy.
Yeah,
it's just different type of feel. So if you want to have that kind of peace of mind where you're like, okay, I'm aiming a little bit more for appreciation, not for the cash flow. Yeah, guess what? Like at least your property is not going to be you're losing money every single month, like what we have here in Canada or in Ontario. Going there, I think you can choose A-class neighborhood in Cleveland, but then the comparison now is between is A-class neighborhood better in Cleveland or a B-class neighborhood in Columbus better? Right? You want to do that comparison because here's the thing, cash flow is still there, right? If your capital requirement can go a little bit higher, you might as well go into a different city that has a higher appreciation.
Yeah.
Yeah.
That's the thing that people have to consider too. So if we're just talking about potential cash flow, personally, my opinion when I was looking at the A-class neighborhoods is that these are probably properties that you'd want to buy if you want to live there, right?
100%, yes.
That's how I felt, right? And then some of these homes, they weren't exactly geared to be multi-units, for example, right? Like they look like single-family homes, right? But the price point in the A-class neighborhoods seem to be anywhere between, $300,000, $400,000, right, for single families, and these are nice properties, right? $450,000 is like really upscale. And then, but when we're looking at the B-class neighborhoods, for anywhere between $150,000 to, let's just say, pushing $300,000, you can get some nice multi-units.
Yeah, exactly. Triplex or duplex at the front, one house in the back. You can potentially get a fourplex, right, in a closer to C-class neighborhood.
Exactly. I know that we were looking at a fourplex over there in like a very up-and-coming neighborhood. It was kind of like B+.
Yeah.
And it's looking like, and it looks like the price point for that one is about $370,000 for 4 units.
Yeah, and each unit will rent for $1,100, so $4,400.
Yeah, and we're talking about minimum improvements, right? So we're going to get into things like mortgage and financing options, which I think is going to be a lot of people's questions. Like, okay, all these properties might sound great on paper. Now, how do I buy one? In terms of financing, you can talk to a bunch of mortgage brokers and everybody's going to tell you what they think and what they're experienced with. You want to find somebody who has dealt with Canadians, ideally. And I think the answer we got from the mortgage broker that we like is when they say, when we ask the question, is there any problem with us, being Canadians buying? And they say, well, is your money green?
Yeah, exactly.
And it was like, that's the answer we want. If the money's green, we can do business, right?
That just tells us that the lenders only look at the performance of the unit or building, right? And that's typically what that's what we call investor-friendly lenders, right? You're going to be dealing with them anyway.
Exactly, right? And these are going to be a little bit more similar to our private lenders over here. It's just not as expensive. However, I think it's important to realize that this will come with a little bit more of a cost to it, right? Because if you are coming in as an international person, you're going to go private, you're definitely not going to be getting as good rates as somebody who's locally operating there and who is buying something that just simply makes sense. But there, the nice thing is that you can finance way more things. There are a lot more finance options. You can finance the property and you can finance your renovations, which that's a big difference than what we have here. I mean, try flipping a house here, right? Flip a house here, you need what, like $150,000 to buy the place, and then you need another like $150,000 to flip the place, you're looking at $300,000 to $350,000 in capital that you need. And you can go on the cheaper side and do like with $250,000, but that's all hard money that you need to put forth. How much do you need if you want to do this in Cleveland?
No,
20% of the total budget. If you're in $150,000 to buy it and then $60,000 to renovate it, that's $210,000. You need 20% or 25% of $210,000.
yeah, everything can be leveraged.
Astronomically different.
Yeah, exactly. And that's why I can't justify why people are actually building the garden suite here. Garden suite, the cost of that cannot be financed, right? Then some people are arguing that, hey, listen, I can do the HELOC, right? So everything's actually financeable. But yeah, if you do that, you allocate it into Ohio, right? Cleveland, Columbus, you only take 20% of those funds, right, to acquire an asset and to do a renovation, home improvements, and all that stuff, which means it'll give you 2 or 3 different assets that you can acquire, right? So I don't know. Sometimes when you're being aware of there's other options out there and being willing to even consider those one and look into some information will give you way more options. And ROI makes sense. Landlord tenant board over there makes way more sense. And the truth is, once you get in, you start building your US credit, which means in 2 years, your options is going to be even more.
Yeah, and the nice thing I like about it is that you can tell a market is mature or an industry is mature when they have products geared towards strategies that are apparent in the market. Like the Burr strategy has a mortgage product.
Yeah.
Have that mortgage product. Here's just call it simple refinance. You can apply to programs and to products that mortgage institutions have where they know that this is what you're doing and you're going to refinance out and they can assess it.
Yeah, it's still a part of the refinancing process, but at the same time, over there is just a lot easier, right? And also like you can do that through a blank mortgage, right? Let's say if you own, let's say 5 or 10 different small single family homes, you can bundle them all together and use a commercial mortgage to do that. Whereas over here, right, everything we do under 5 units is tied in with our personal name, personal income.
Yeah, no, performance here isn't taken into as strong consideration as it is over there. Canada views a lot of these properties as single family homes. And the thing is that banks are also not unaware of the challenges that you as a borrower can face with, tenant performance, let's say.
I don't think they care. So
because there's actually the risk, and the risk assessment is higher because, let's face it, renting out your property is very risky here. So that's why I think things are the way that they are.
Possibly, yeah.
After your mortgage and everything, roughly, what does the cash flow look like?
Again, single family in B-class neighborhood, worst case scenario, after paying everybody $250. Yeah, but now you also need to budget some surprises, right? Roof leaks and all that stuff, right? Throughout the year.
We did already budget that you're going to be spending home improvement funds on it. So the maintenance, at the point where you're spending an extra $40,000 that you're going to finance on the property, you shouldn't expect too many problems.
For sure. I agree. Okay, so here's the thing though. Baseline, this is what people can expect. And again, building a bit of a buffer. So $200 cash flow. Not that great, but at the same time, single family home over there, you can do a lot with it. Such as, if you want to actually find if you only want to touch single family home without adding different units or, finding an apartment building, another thing you can do is allocate those funds into a better area and see if you can do Airbnb, see if you can do co-living. The place that we stayed there, they did a higher end renovation. Hey, guess what? Our Airbnb cost wasn't cheap, right? It was still about like $300 per night. Right. Yes, it was nicer, but it was in almost the same neighborhood as all the other properties that we looked at. Right. So if you kind of position it correctly, right, and want to kind of build up that buffer for the cash flow, you can still do that with single family.
Yeah, and the thing is that this is now limiting yourself to something that is extremely, let's face it, easy. Because even the property management is not going to be that complicated over there. Because we're talking about single family. If, let's say, you decided to operate a duplex and you bought it for, again, around $160,000, you have the same numbers, but instead of $1,600 rent, you're now talking about maybe $900 to $1,000 rent per unit, and now you're looking at $2,000. So that $300 cash flow now turns into about $700, where now it's like pretty now that's considerably more comfortable to be saying, okay, I'm going to park $70,000 and I'm going to get $700 a month positive cash flow.
Yeah, exactly.
So the thing is that with the options that Canadians have, where they're now looking at, investing further away, investing north, even moving to places like Alberta, right, where it's a little more landlord friendly, but even there, properties are now getting a little more expensive, right? And let's face it, I do know some people who moved to Alberta, and during the winter, they're just like, it's really cold, right? So, when they were really advertising it, they were doing that in the summer when it's green, it's lush, it looks beautiful, right? But it's a nice place, but it definitely has some of its setbacks, some of its drawbacks.
100%.
A lot of these investment options are very capital intensive. And the thing is that not only is the cash flow minuscule, highly capital intensive, minuscule cash flow, and pretty high risk if you ask me when you consider the tenant population and the rules surrounding it. So when you look at all these things, even if you're the type of person who's saying, hey, I want to be able to drive to the property, it really does make places like Cleveland, Ohio look very attractive when you start to look at the numbers and the distance.
Yeah, and here's the thing. Ohio doesn't need to be the place where you scale. Just a place where you start, right, in the US market. After that, you get used to how the lending criteria and all that stuff works, right, and also understanding the states. Because after you get into Ohio, you're not going to just look at Ohio. You're going to look at elsewhere, right, because now you're a little bit more familiar with the regulations and all that stuff. Your connection started expanding, right, according to your investing strategy, right? So you might be looking at somewhere closer to Florida, Texas. Some people really like Arizona, Vegas, right? Go look at those places. But you really expand that option and even like our vision a lot more. So again, like the idea is to get all of us to start in investing into a place where your cash flows from day one. That's really important. And second thing is the capital requirement is not going to be that high. And third thing is after you get that, pull that trigger, moving forward, the option is going to be pretty much like unlimited.